So today we are going to be looking at adjusted present value, and APV is a very technical uh, subtopic in strategic financial management, such that unlike net present value, that is one directional, APV is looking at two angles. One is the cash flow from operation, then the other one is the cash flow from financing. So APV incorporated financing with the normal operation of the company in relation to the determination of financial viability of a project. So that's why APV is more technical relative to net present value. Therefore, for you to do well, for you to be able to appreciate the dictates of adjusted present value, you must understand the underlying principles and also the procedures involved in determination of financial viability of a project using adjusted present value. Once you are able to master the procedures, every other thing will fall into places for you in the calculation of APV. So I will take my time right now to explain to you the steps that you are going to carry out whenever you want to calculate adjusted present value. And one more important thing I need to inform you is the fact that we can't solve more than one illustration because APV takes time to complete. All right. So considering the fact that we have a limiting factor, which is insufficient time. All right. So I won't be able to solve more than one illustration. Again, um, if you need additional illustrations on question and answers, so you can, I'll provide you, I'll be sharing it with you already, so you can have a good resource that details all of that in the material. But that notwithstanding, let's go straight to the lecture of the day. All right. So what do you understand by adjusted present value? So simply put, APV is a technique designed principally to appraise a project where the debt equity proportion or financial risk of a company are expected to change significantly as a result of undertaking a project. I take it again. APV is a technique designed principally to appraise a project where the debt equity proportion or financial risk of a company is expected to change significantly as a result of undertaking a project. APV is a technique that separates cash flow from operation from cash flow arising from financing and appraise each of them independently. I repeat, APV is a concept that separates cash flow from operations from cash flow arising from financing and appraise each independently. Distinctively, APV is a technique that is similar to the net present value. APV is a technique that is similar to net present value. However, what makes APV to be unique is the fact that if issue cost or subsidized loans are given, if issue costs or subsidized loan are given in a question, then you should know that you are supposed to use adjusted present value to appraise the project, because NPV does not make use of subsidized loan or issue cost. So what I'm trying to say in essence is the fact that APV and adjusted present value and the net present value are very similar. It's the same way examiner will structure the question. It's the same way examiner will state the requirements. Examiner will just tell you to evaluate or advise. Okay? So, but examiner may not tell you to use either APV or NPV. And that's what I said, that it is similar to NPV. However, the only uniqueness of APV, or the only thing that make an APV to be distinct from NPV, is if in the question you are given issue cost or subsidized loan. Once you see issue cost or subsidized loan, you need nobody to tell you that you are supposed to evaluate using adjusted present value. I repeat, if in a question you are given issue cost or subsidized loan or subsidy, then you are supposed to use adjusted present value, because NPV does not consider itself with issue cost or subsidized loan. Therefore, how do you calculate adjusted present value? So let's move to the next one, calculating adjusted present value. In the determination of adjusted present value, the following procedures should be considered. Let me switch to my working notes so that you appreciate what we're about to do. Okay, so calculating adjusted present value. Can you see my screen, please? Can
Yes,
you?
yes,
All
yes,
right then. Thank you. So calculating adjusted present value. When you want to calculate adjusted present value, there are basically 4 procedures you are supposed to carry out. Step 1, calculate base case NPV. Calculate base case NPV. Step 2, calculate present value of financing effect cash flow. Step 3, compute adjusted present value. Step 4, advice. So these are the 4 procedures that you are going to carry out whenever you want to calculate adjusted present value. You see, life would have been very easy in the determination of adjusted present value if you can just go to the question and just bring in your base case NPV directly. Okay, just come and post. You go into the question, just go and pick the PV of financing effect cash flow. Life would have been so easy as far as APV is concerned. You see, in step 1 and step 2, there are several procedures that you are going to carry out to determine base case NPV and the PV of financing effected cash flows. Therefore, let's take it one by one. When you want to calculate base case NPV, what are you supposed to do? Okay? So I will say A, calculating base case NPV. In the determination of base case NPV, in the determination of base case NPV, the following procedures should be considered. Step 1, calculate relevant cash flows or determine relevant cash flows. That's the first procedure. Determine relevant or net cash flows. Now, in this step 1, the same way when you want to calculate base case NPV, the normal way you calculate your regular net present value is the same way you are going to calculate your base case NPV. The only difference is just the fact that instead of discounting your net cash flow using the WACC of the company, you are going to use cost of equity on gear to discount the net cash flow. That's just the difference. So what this means is that in this step 1, in determining the relevant cash flow or net cash flows, you go into the question, am I given selling price? If you have selling price, you ask yourself, is there any inflation rates? If selling price will be impacted by inflation, then you go and inflate the selling price. You multiply your inflated selling price with number of units, a number of units or units sold. You have your total sales, then you go and post. You go into the question, do you have variable cost per unit? If yes, is there any inflation that affects variable cost? If yes, then you inflate. You multiply your number of units produced, then you have your total variable cost. You go and post. You go back to the question, am I given incremental, attributable, specific, fixed cost? So when you have all of that, is there any inflation that will impact the fixed cost? If yes, you inflate, then you post. So these are the things you need to do. You consider your tax, you consider your working capital, and all the things that you normally do under net present value are what you are going to do to get your net cash flow. The step 1. Then step 2, calculate cost of equity on gear. Cost of equity on geared. KEU. This can be calculated. This can be calculated as follows, depending on the information of, depending on the proxy information or depending on information of proxy given. Okay? Therefore, now when you want to calculate your cost of equity on gear, you need to check from the question how you are going to calculate your cost of equity on gear. Now, this cost of equity on gear relies heavily on the information of a proxy company, comparable company. There are 3 ways in which you can calculate your cost of equity on gear. The first way is that if you are given beta of a proxy, if beta of a proxy is given, so if you are given beta of a proxy, then how do you calculate your cost of equity on gear? Under this, there are 3 procedures. The first procedure is to calculate or identify the proxy beta. Identify the proxy beta. Step 2, ungear the beta. Ungear the beta if geared. Okay. Step 3, calculate cost of equity using capping. All of this we have done. There's no need for me to give you a formula. We've done this when we had the project-specific cost of capital. It's the same thing. The same way you are going to ungear beta, the same way you are going to do here, the same way you calculate your capping, the same way you are going to do here as well. So no need to give you a fresh formula for that. So these are the 3 procedures. Please note that when you are calculating cost of equity under APV, when you are calculating cost of equity on gear, you don't re-gear. If you are given beta of the proxy, you don't re-gear when you are calculating cost of equity, because once you re-gear, it means that you are incorporating financial risk. Remember, we want to calculate cost of equity on gear. So the cost of equity on gear is the one that measures only business risk. So we are less concerned with financial risk, because once you re-gear, it means that you want to incorporate financial risk. So don't do that. As far as APV is concerned, if you are given beta of a proxy company and you want to calculate cost of equity on gear, you don't re-gear. So the first thing you are going to do is to identify the proxy beta. You ungear the beta. If it is geared, then you calculate capping. Generally, you are supposed to calculate POC. That's the acronyms for the steps you are going to carry out. So that's for that. Then move to the next one. If cost of equity of a proxy is given, if cost of equity of a proxy is given, then in this case, if cost of equity of a proxy is given, you are supposed to calculate cost of equity using Miller and Modigliani formula. If you recall, when we had cost of capital, when we had cost of equity under traditional WACC, I mentioned to you that there are 3 ways of calculating cost of equity. Number 1, cost of equity using dividend valuation model. Number 2, cost of equity using capital asset pricing model. Number 3, cost of equity using Miller and Modigliani formula. And I mentioned to you then that when we get to APV, I will demonstrate for you how to calculate the cost of equity using Miller and Modigliani. So if that is the case, how do you then calculate cost of equity using Miller and Modigliani? Therefore, I would then say, according to Miller and Modigliani, cost of equity of a gear is calculated as cost of equity on geared plus, open a bracket, cost of equity on gear minus cost of debt, which is your cost of borrowing, your interest rates, multiplied by debt into 1 minus tax, or divided by equity value. So this is the formula you are supposed to use whenever you want to calculate cost of equity using Miller and Modigliani formula. I repeat, the KEG represents cost of equity of a gear company. Then KEU represents cost of equity on gear. KD means cost of debt, interest rates. D is debt value. E is equity value. C is the company tax rate. Please note that all the information that you are going to use for all the variables you have here, the information you are going to use for the variables you have here are the information of the proxy company, not of the main company. The cost of equity of a gear must be cost of equity of the proxy company. So what you want to calculate is the KEU. You are not given the KEU, but KEG will be given to you. All other variables will be given to you. So you are going to use the known variables to get the unknown variable. So at the end of the day, you get value for your KEU. At times, examiner may not give to you KD, cost of borrowing, which is the interest rates associated with the debt. So if cost of debt is not given to you, what do? You are going to use the risk-free rate of return as a replacement for cost of debt. But where cost of debt is given to you, there's no need for you to assume risk-free rate of return as your KD. So number three, the third way of calculating cost of equity on gear is to use WACC. If you are given WACC, number three, if WACC of a proxy is given. So if you are given WACC of a proxy, how do you then calculate cost of equity on gear? So the WACC of it, to get cost of equity on gear, I will say WACC of a gear equal to WACC of on gear company multiplied by 1 minus debt value multiplied by tax rates divided by equity plus debt. So this is the formula you are supposed to use to calculate WACC or cost of equity on gear. So that's that. Then note that the WACC of on gear company is the same thing as cost of equity on gear. Now the bottom line here is the fact that examiner will give to you WACC of a gear. This other part will be given to you. This is the unknown that you want to calculate. The WACC of on gear will never be given to you. Therefore, you are going to use the known variable to get the unknown. Every other one will be given. Of course, the D is the debt value. T is the tax rate. Say, for example, the debt is 500 million naira. The debt value is 500 million naira. Okay? And the company tax rate is 30% or 25%. I will just say 500 million multiplied by 30%. Okay? So D multiplied by tax rates, then divide by the equity value plus the debt value. That's how you are going to calculate your cost of equity on gear. But the beauty of this is that you cannot, the three of them cannot be given in a question. Only one will be given to you on that day. So what this simply means is that whichever one that is given to you is what you are going to calculate for. But the bottom line is that you have to memorize the three ways of calculating the cost of equity on gear. You have to master them. You have to memorize them. So it's not sufficient for you to be guessing or thinking that, okay, this is the one that will come out. You don't know which one will come out. And that's why it is important for you to memorize the entire formulas of calculating cost of equity on gear. Okay, then. So we stop at step 2. We now move to step 3. Step 3 says calculate present value. Calculate present value. So how do you calculate the present value? This can be done by multiplying the discount factor with the net cash flow. Okay. So once you are done calculating you have calculated the net cash flow. You've also calculated the cost of equity on gear. So all you need to do is to discount your net cash flow to get the present value. So once you get the present value, then you move to step 4. Step 4 says calculate base case NPV. Calculate base case NPV. Of course, the base case NPV represents the difference between the present value of cash inflow and present value of cash outflow. So that will give you the base case NPV. Once you have your base case NPV, you keep it on one side. Then you now go to the second part of your APV. Okay then. So these are the 4 procedures that you're going to carry out whenever you want to calculate base case NPV. One thing that is noteworthy in this base case NPV is that the same way you calculate your normal NPV is the same way you are going to calculate your base case NPV. But the only difference is just that instead of you to discount your net cash flow using the WACC of the company, rather you are going to calculate the cost of equity on gear. So you are going to use cost of equity on gear to discount the net cash flow. That's just the difference, all right? So at this point, we then move to the second one, which is we are done with base case NPV. Let's go to calculating PV of financing deferred cash flow. Number B, calculating PV of financing.
Excuse me, sir.
Yes.
So please, can you explain the step 3 and 4 of this calculation of base case NPV?
Step 3 and 4 is something you're already familiar with now. So we just finished NPV, right?
Yes, sir.
It's the same way now. Hey, how do you calculate your present value? Is it not discount factor multiplied by your net cash flow? Isn't it?
Yes, sir. Yes, sir. But you
Uh-huh.
said something about the discount factor.
It's the same discount factor. See, once you calculated your cost of equity on gear in any of these 3 ways I just explained, what I'm saying here is that if you are given a beta of a proxy company, there are 3 steps you are going to follow. These are the 3 steps. Step 1, identify the beta, ungear the beta, then you calculate your cost of equity on gear. So once you get your cost of equity on gear, that will represent your cost of capital, which you are going to use as a discounting rate. So you now use it to discount your net cash flow. Whatever you have thereafter will become your present value. And you know that your base case NPV is the difference between the present value of cash inflow and present value of cash outflow. So it's not different from what you used to know under normal NPV. Again, if in the question you are given, after you have calculated your net cash flow, you now want to calculate cost of equity on gear, you go into the question and you are given cost of equity of the proxy company. So what that means is that you need to use Miller and Modigliani formula. Okay, you need to use Miller and Modigliani formula. This formula I just provided here to calculate your cost of equity on gear. Once you have that done, then you need to go and discount your net cash flow to get your present value. The difference between present value of cash inflow and the present value of cash outflow will represent your base case NPV. Again, finally, you go into the question after you have calculated your net cash flow. If you are given WACC of the proxy company, it means that you are supposed to calculate WACC of on gear, and your WACC of on gear is the same thing as the cost of equity on gear. So using this formula here. So any of those three ways is the one you are going to use to calculate cost of equity long gear. Once you have that done, you discount your net cash flow, you have your present value, then you get your base case NPV. So it's not, like I said, it's the same way you calculate your normal NPV that you are going to calculate your base case NPV. The only difference is just the fact that you don't use the company WACC. Rather, you are supposed to use cost of equity on gear, which of course we are the one that will calculate it. Your examiner will never give you under APV. You are the one that will calculate the cost of equity on gear. All right. So move on to financing effects. Now, when you want to calculate PV of financing effects, there are three components. There are three major components that will make up present value of financing effect cash flow. The first one is to calculate present value of issue cost. You calculate present value of issue cost. You come and post. Of course, generally it will be in brackets because cost is involved. Then you go into the question again. If you are given subsidized loan, then you need to calculate present value of net subsidy. It's a cash inflow. Then if in the question there is an external borrowing, that is normal borrowing, then in that case, you need to calculate present value of tax saved on interest. It's a cash inflow. When you add it together, it will either be positive or negative. This represents the PV of financing effects. You see, again, would have been very interesting if you can just go to the question and pick all the three elements I just listed here. But again, it doesn't work that way. So you have to work it out yourself, one after the other. So let me show you how to calculate PV of issue cost and PV of net subsidy, as well as a PV of tax saved on interest. How do you calculate each of them? Now, before you do anything, whenever you want to calculate PV of financing effects, there are some assumptions that you need to make. The first assumption is that, is a general one. The first assumption is that you need to determine, are you using gross finance required or net finance required for calculating the PV of net subsidy and PV of tax saved on interest? So from the beginning, ab initio, you must establish this situation. So you want to know whether you are supposed to use gross finance required or net finance required. Okay, let me just put it down because of time. In the determination, in determining the PV of financing effects, cash flow, ascertain if you want to use the gross finance required or net finance net finance required for the calculation of PV of net subsidy and tax saved on interest. Okay, that's number four. That's number one assumption. The second one is that as far as PV of financing effect cash flow is concerned, there is no unestablished rules as to the discount rate to be used to appraise the cash flow arising from financing effects. Because M&M, those two controversial guys are the ones that propounded this technique, that propounded this technique, and they failed to tell us which technique, which cost of capital or discount rate should be used for discounting the cash flow arising from the financing effects. Therefore, you are at liberty to either assume cost of borrowing or risk-free rate of return. Okay. In addition, in addition, you can either assume cost of borrowing, that is normal borrowing rates, your interest rates. You know, when you borrow from the bank, the interest rates that you are going to pay, that the interest you are going to pay, so the interest rates, the coupon rates, is what is called normal borrowing rates. Okay? You can either assume cost of borrowing or the risk-free rate of return. So whichever one that you use, if examiner did not specify, so you're at liberty to either use cost of borrowing or risk-free rate of return. Let me explain to you once again. When you want to calculate the PV of financing effect cash flow, these are the three elements that will make up the PV of financing effect. It can't be more than these three. The issue is that when you now want to calculate the PV of net subsidy and the PV of tax saved on interest, you will need to discount. When you say PV, it means that you have to discount whatever cash flow that will arise from issue costs, net subsidy, and tax saved on interest. So, which cost of capital or which discount rates are you going to use to discount the cash flow from financing effects? So that's what I'm now saying, that in determining, let me write this. In determining the PV of financing effect cash flows, ascertain if you want to use gross finance required or the net finance required for the calculation of PV of net subsidy or tax saved on interest. So you need to establish that from the beginning. So if that is the case, if you want to use net finance required, you need to go and calculate your net finance required. If you want to use gross finance required, you go in there and calculate your gross finance required. Then your second assumption is that, okay, now that I have the PV from net subsidy and tax saved on interest, how do I calculate my PV? Because once you have those cash flows from cash flow from the financing, yes. So you need to determine how you are going to calculate the present value. And for you to get the present value, you are going to need a discount rate. Therefore, you are at liberty to either assume the cost of borrowing or the risk-free rate of return. Whichever one that you assume is what the examiner will mark for you. There is no penalty for that. So nobody will tell you, except if examiner says otherwise. At times, examiner may ask you to use either cost of borrowing or risk-free rate of return for your financing effect cash flow. But where examiner is silent, you are at liberty to use any one. However, at all time, I will advise you to always use cost of borrowing because cost of borrowing will always be higher than the risk-free rate of return. Okay? So that's for that. Therefore, without wasting more time, how do you then calculate the net finance required? So I would say net calculating. All this I'm giving you is not in any material. So just make good use of them. So calculating net finance required. NFR. Okay. So in calculating the net finance required, I will say net finance required equal to, now, when you want to borrow money, the money you want to borrow at the end of the day, once you get the money, that the money that you are going to receive will be the net amount. Something must have been deducted from the source. Therefore, when you now want to calculate the cash flow from financing, you pick your initial outlay, the initial outlay for the project plus the working capital. That's the two elements that will make up the net finance required. So it is assumed that the working capital, let me just note, it is assumed that the working capital for the subsequent years, for the subsequent years will be financed with the internally generated funds, will be financed with the internally generated funds. Okay, so this working capital, of course, you are going to receive at the beginning of the project. So you had it to year zero initial outlay. So it means that going forward, whatever the cash flow that the project generates is what you are going to use to finance your working capital. That's generally the assumptions. All right then. So how do you then calculate the gross finance required? Gross, calculating gross finance required. GFR. GFR equal to the net finance required divided by 1 minus issue cost rates. Okay? 1 minus issue cost rates. So that's the formula you are going to use to get the gross finance required. So these are just all what we are just discussing now for the past 5 minutes or thereabout. They are just elementary. So we have not even started we have not started calculating PV of issue cost itself, PV of subsidized loan or tax saved on interest. So therefore, how do you then calculate PV of issue cost? I would then say calculating PV of issue cost. Now, you must first of all understand what is issue cost before you can be talking about um, how to calculate PV of issue cost. So you can say issue cost, issue cost represents the costs associated with underwriting and raising debts and equity capital and equity capital. E.g., e.g., market expenses, market expenses, investment banking fee, investments, banking fees, legal fees, okay, uh, registration fees, registration. This registration fee is the fee paid to Security and Exchange Commission, so ETC. All right. So these are some of the examples of issue cost. Now, like I was trying to say the other time, when you talk about issue cost, when a company wants to raise finance, when a company wants to raise capital, say for example, you want to raise capital through bond, okay, through debt, that is bond. So that capital that you want to raise is not for free. There are costs that are attached to it. So generally those costs will be deducted from the source. It has before the company will receive the finance, they would have deducted something from the source. So that deduction represents the issue cost. It is the net amount that the company will receive at the end of the day. Say, for example, a company wants to go for IPO, initial public offer, to raise capital in the market or through the public. That capital that at the end of the day, the capital that the company will receive is the net amount. Some expenses would have been incurred before the capital is being raised. So those expenses that was incurred or that were incurred before the company finally get the funds represent the issue cost. So generally, now the issue cost, the issue cost associated with debts will attract the issue cost associated with debts will attract tax relief, that is benefits in the first year. However, there will be there is no tax benefits, there is no tax benefits for raising equity capital. So that's for that. Because of time, so let's move on. How do you then calculate present value of issue cost? What I've done so far is just to bring you to the understanding of issue cost. So when I want to calculate present value of issue cost, the first thing I need to do, your first step when you are calculating present value of issue cost is for you to determine the issue cost amount. So determine the issue cost amount, ICA. How do you calculate issue cost amounts? Issue cost amount is calculated as the gross finance required multiplied by issue cost rates. So that will give you the issue cost amount. Step 2, calculate the PV. Calculate the PV of issue cost amounts. Calculate the PV of issue cost amounts in year 0. How do you do this? Very simple. Whatever you have as your issue cost amount is what you are going to have as your PV of issue cost in year 0, because discount factor at year 0 is equal to 1. So I would then say PV of issue cost amounts equal to issue cost amount multiplied by discount factor at year 0. So whatever I have, I will go and post. Of course, it has to be in brackets. Then the second part is for me to calculate, like I mentioned to you, the issue cost of raising debt capital will attract tax relief in year 1. Therefore, I need to calculate tax saved on issue cost in year 1. Calculate tax saved. Calculate PV of tax saved on issue cost amounts in year 1. In year 1 only. Uh, Calculate PV of tax saves on issue cost amounts in year 1. Okay. How do you do this? Simple. I will say PV of tax saved equal to the issue cost amount. Anything that has to do with tax saved, what do? You multiply it with company tax rates. So I will say issue cost amount multiplied by company tax rates, then multiply by discount factor at year 1. Whatever I have, I will post. So the difference between the two will give me, of course, it has to be negative. So the difference will give me the PV of issue cost. If you like, you can say the nets, because so this is how to calculate the present value of issue cost. Now, once I'm done with present value of issue cost, I need to go ahead and determine the present value of net subsidy. Let me see which number did I say? Did I number them? Okay, no. All right then. Just adding. Let me just asterisk. Then I want to calculating present value of net subsidy. When you want to calculate present value of net subsidy, there are 4 procedures you are supposed to carry out if necessary. The first procedure is to determine the subsidy amount. Determine the amount attributable to subsidy. Determine subsidy amount. SA. How do you calculate subsidy amounts? Subsidy amounts equal to the gross finance required. That is, if you are using gross finance required. So all my explanation is on the basis of gross finance required. In fact, except the examiner has you to use net finance required, it has to be gross finance required. So except if examiner wants you to use gross and net finance, then you go ahead and you use net. But at all time, where examiner is silent, you have to use the gross finance required. Therefore, when I want to determine the subsidy amounts, I will pick the gross finance required, then I will multiply for the proportion of subsidy. Proportion of subsidy. What do I mean by proportion of subsidy? When you need finance, say for example, you want to raise 1 billion naira, then you are now told that there's a subsidy of 70%. You need 1 billion naira. So 70% of the 1 billion is attributable to subsidy. It means that the balance of 30% will be normal borrowing. That is, just go to your bank and borrow the 30% of your 1 billion. Say, for example, you need 500 million naira. What do you do? And you are told in the question that out of the 500 million naira, 60% is attributable to subsidized loan. It means that the remaining 40% is for normal borrowing. So this is the way examiner will propose the scenario. So you should know what to do at the right time. So this is how to calculate your subsidy amount. Just multiply the gross finance required with the proportion of the subsidy. All right. When you say proportion, it simply means percentage of subsidy. All right. Then step 2, calculate savings on subsidy. Calculate savings on subsidy. SOS. This SOS must be in percentage. So how do you calculate SOS? I would then say SOS, of course, in percentage, is calculated as the normal borrowing rates, normal borrowing, that is interest rates on normal borrowing. Let me write it. Normal borrowing rates minus subsidy rates. Minus subsidy rates. This is normal borrowing rates. This is subsidy rates. When I say normal borrowing rates, what it simply means is interest rates on your normal borrowing. When you want to borrow through markets, so the interest that you are going to pay on the loan that you want to borrow is your normal borrowing rate. Then your SR simply means subsidy rates. Is the interest rate associated with the subsidy or with the subsidized loan? So that's just that. Then, of course, step 3. Step 3, what are you supposed to do? You calculate net subsidy. Calculate or determine net subsidy. NS. So net subsidy is calculated as subsidy amount multiplied by savings on subsidy in percentage multiplied by, when you say net, net means 1 minus tax. then multiply by 1 minus tax rates. So this will give me the net subsidy. Finally, once I get the net subsidy, I need to calculate the PV of net subsidy. So the PV of net subsidy, PV will then be calculated as net subsidy multiplied by annuity factor. Net subsidy multiplied by annuity factor. So remember what I told you before, when you are calculating, before you start calculating your PB or financing effect cash flow, you must establish whether you want to use, whether you want to assume normal borrowing rate or risk-free rate of return as your discounting rate for financing effect cash flow. So once you have established that, then you need to go and calculate your annuity factor using that particular rate. So whatever it is, just use it to multiply. So this is what you need to do under PV of net subsidy. Finally, calculating PV of tax saved on interest. So when you want to calculate PV of tax saved on interest, there are three procedures. The first procedure is to determine accumulate all interest elements. Accumulate all interest elements. How do you do that? You go into the question. If you have subsidized loan, therefore you need to calculate the amount of interest paid on the subsidized loan. So I would then say interest on subsidy. How do you calculate interest on subsidy? Your normal, the amount attributable to your subsidy, the subsidy amount multiplied by subsidy rates will give you the interest expense on the normal subsidy. Whatever it is, go and post. Then you determine interest on normal borrowing. The interest the company will pay on normal borrowing. Interest expense on normal borrowing. So this is the borrowing through bank or any external or from the market. Again, the amount attributable to normal borrowing, the amount or the proportion of the loan attributable to normal borrowing, they multiply by normal borrowing rates. Okay? So whatever it is, you multiply, then you add. That is, this is um, normal borrowing. Normal borrowing, let me write this because of space. Normal borrowing, then multiply by normal borrowing rates. Normal borrowing rates. So you have this here, you have this here. How's that? So you have this as total. This is total interest expense that the company will pay. Total interest expense that the company will pay. So that's the first step. After you have gotten the total interest, the next thing you need to do is to calculate tax saved on interest. Calculate tax saved on interest. So how do you do this? I would then say tax saved equal to the total interest elements. total interest elements multiplied by company tax rates. Whatever it is, I put it there. Then finally, I need to calculate PV of tax saved on interest. How do you do that? So the PV of tax saved on interest, PV will be calculated as tax saved multiplied by annuity factor. So whatever I have, that's it. So once I have this done, once I'm done with calculating with PV of issue cost, PV of net subsidy, PV of interest, of tax saved on interest, then I'll just come and post under this area. So I'll just come and post here. All right, so that's that. This is how to calculate. Once I'm done with this, then I move to step 3. Step 3 is to calculate APV. So number C, calculating adjusted present value. So APV represents base case NPV. Base case NPV, whatever I've calculated, positive or negative, then I will then add or minus PV of financing effects, cash flow, positive or negative. At the end of the day, my APV could be positive or negative. So this is how to calculate adjusted present value. Finally, step D, you need to advise. So decision rule. The decision rule for APV is the same thing as decision rule for NPV. So if APV is positive, you accept the project. But if not, you reject. Where you have mutually exclusive projects, accept any projects with a higher positive APV. All right? In fact, you can't even have mutually exclusive in APV. That would be too much. Even a single project, one is still struggling, let alone now having mutually exclusive projects. Okay, so these are the procedures of calculating adjusted present value. Let me know if you have any question for me so that we can go straight to calculation. All right, any questions so far? You can see, you can see what I was telling you earlier today, that APV is more technical relative to the normal net present value. So you are going to sweat when you have question on adjusted present value because it's tedious. But once you master these procedures, so you are good to go. There is no material you are going to see the breakdown of the procedures of calculating APV like this, like I've done. So you can either see it the way I've done it, or even see it uh, in a more simplified form in my SFM material. So you can't get it anywhere like this. So let me know if you have any question for me before we begin to solve question.
Sir, please, can you display the what's it called, the decision rules again, please? I didn't really get it.
I said the decision rule. If
Eh,
APV is positive, you accept the project. If negative, you reject the project. That's all. All right? Is it clear?
yes, I see. Thank you.
All right then. Okay. So at this point, I will stop sharing the working notes. Let's move to illustration. So Zainab has joined. Zainab, you are welcome. Believe, you are welcome too. Where is Fidelis? He has run away to watch ball or what? In any case, let's move on. Okay. So once you already have the material, and I believe you have gone through this, so by now you would have gained one or two things. So you can go back to your material and read more. So you're going to read about the advantages and disadvantages of adjusted present value. All right, go and read it. There was a particular question in a diet when ICANN was asking this. It's a sub requirement. So please do well to go through them. All right then. So let's have this illustration. Let me see. Somebody should please read for us. Who will help us to read? Yes. You want me to call name? I need a volunteer. User, because you came late. You are read. User.
Okay, sir. I not came in late.
What's the name again?
Fidelis.
Why are you using different number now? You did not. You didn't come
I
late. I know.
switched, I
Oh,
switched over to my system.
oh, okay. Okay
Yeah.
then. I've already mentioned your name. Yeah, Fidelis, read.
All right, sir. Illustration number one is A Limited is an unlisted company based in Akure, Nigeria. Over the years, the company has been producing and selling agricultural support tools. EL is now considering the production and sale of yam pandas. Although this is a completely new venture for EL, it will be in addition to the company's core business. EL's directors plans to develop the project for a period of 4 years and then sell it for 24 million to a group of young investors. The government is excited about the project and has offered EL a, a subsidized loan of up to 80% of the investment fund needed at the beginning of the project at a rate of 200 basis points below AL's borrowing rate. Currently, AL can borrow at 300 basis points above the 5 years government debt yield rate. A feasibility study commissioned by the directors at a cost of 5 million had produced the following information. One, the company can buy an existing suitable factory at a cost of 16.5 million payable now. Two, 4.5 million is required now to buy and install the necessary plant and machinery. Three, the company will produce and sells 1,300 units in the first year. Unit sales will grow by 40% in each of the next 2 years before falling to an annual rate of 5% for the final year. 5, unit sales price for the first year will be 3,750 naira, but this will increase by 3% per year thereafter. In the first year, total variable cost per unit will be 1,800, but this will increase after the first year. AL will require working working capital of 15% of the anticipated sales revenue for the year. At the beginning of each year, the working capital is expected to be released at the end of the fourth year when the project is sold. ALC's tax rate is 25% per year on taxable profits. Tax is payable in the same year as when the profits are earned. Tax allowable depreciation is available on the plant and machinery on a straight line basis. It is anticipated that the value contributable to the plant and machinery after 4 years is 600,000 naira of the price at which the project is sold. No tax allowable depreciation is available on the factory. AL uses 12% as its discount rate for a new project, but feels that this rate may not be appropriate for these new types of investment. It intends to raise the full amount of funds through debt finance and take advantage of the government's offer of such subsidized loan. Issue costs are 4% of the gross finance required. It can be assured that the debt capacity available to the company is equivalent to the actual amount of debt finance to be raised for the project. Although no other companies produces yam powders in the country, Cantona PLC, CL produces cassava crushing machines using almost similar technology to that required for yam powders. CL's cost of equity is estimated to be 14% and its pay tax at 28%. CL has 15 million shares in issue, trading at 2.53 each, and 4 million bonds, trading at 94.88 per 100 naira. And the 5-year government debt yield is currently estimated at 4.5%, and the market rate is at 4% required. Evaluate on financial grounds whether AL should proceed with the project, 28 marks, and then discuss the appropriateness of the valuation method used and explain the assumption meeting, part E, 5 marks. C, provide example of ethical issues that might affect capital investment decisions and discuss the importance of such issue for strategic financial management, 7 marks. Altogether, 14 marks.
Thank you, Fidelis. You can see this is a very big question, and generally it will come as a compulsory question. And if care is not taken, if a student is not strategic enough, this kind of a question can throw you off balance. And that's why we usually encourage students that whenever you are provided with your question paper, please don't make the compulsory question as your first attempt, because it may disorganize you on that day. And so that's why it is important. Once you get your question paper and the invigilator asks you to start, just go in there and identify the cheapest questions that you can easily solve within 30 minutes. So you pocket about 2 or 3 questions from section B and C. Then you can then go and waste your time on the compulsory question. Articulating how you are going to maximize your score. So the last time ICANN tested adjusted present value was in 2019, and that was this particular question was that question. Okay, it was November in 2019, compulsory. That was the year ICANN changed the syllabus. Then in 2021 again, the syllabus was changed. So ever since then, we've been anticipating that ICANN will set APV again. But again, we don't know what is coming in this May diet. But that notwithstanding, now, whenever you are given a question like this, The first thing first, as usual, is to go to the requirements. Go and identify the expectation of the examiner. In this question, you are to evaluate on financial grants whether Alcantara Limited should proceed with the project. Can you see? There is no difference in these requirements. If I'm the one solving this question, if I don't see issue cost or subsidized loan in the question, what I will just do when examiner is asking you to evaluate, it means that you are supposed to calculate the net present value. Because in this requirement, examiner did not tell us which method, which technique to use to evaluate the project. Are we using NPV, IRR, modified internal rate of return, project duration, adjusted present value? Examiner did not tell us. So you are only asked to evaluate. So the onus is on you to go back to the body of the question, go and identify, go and check the scenarios. So from the scenario, you should be able to deduce or determine which method you are going to use to appraise the project. So let's go back to the body of the question. Remember what I told you. When you only use APV, when the debt equity proportion or financial risk of a company are expected to change significantly as a result of undertaking a project. That particular statement may not be clear in some questions, but what is clear is that you only use APV if in the question you are given issue costs or you are given subsidized loan. It's not compulsory that all the elements of financing effect cash flow will be present in the question. Whichever one that is present is the one you are going to use. But in this particular question, I need to go back to the body and go and read, am I given subsidized loan and am I given issue cost? So let's go back to the question together. So that will be my first attempt. So if you go to in the first paragraph, you are told that Alcantara Limited is an unlisted company based in Akure, Nigeria. Over the years, the company has been producing and selling agricultural support tools. AL is now considering the production and sale of yam pounders. It means that AL is diversifying, okay? Although this is a completely new venture for AL, it will be in addition to the company's core business. AL's directors plan to develop the project for a period of 4 years and then sell it for 24 million naira to a group of young investors. So in this particular paragraph, I've seen the useful life. I've seen the useful life of the project to be 4 years. Okay? Then sell it for 24 million. In this same paragraph, I've seen the scrap value, sales proceed. I've seen sales proceed in this paragraph, which is 24 million. The government is excited about the project and has offered AL a subsidized loan of up to 80%. I've seen what I'm looking for. Examiner has told us there's a subsidized loan. So with this information, I don't need anything again. This has confirmed that I'm supposed to use adjusted present value. I'm supposed to use adjusted present value because NPV does not consider itself with subsidized loan or issue cost. So because of this subsidized loan, I can then go ahead and calculate adjusted present value without wasting more time. All right. So at this point, let me stop sharing these notes. Then we'll move to the working note so that we can quickly start the calculation. We have about 1 hour more. Okay. The name of this company is Alcantara. Alcantara Limited. So calculating adjusted present value. Okay. The first thing first I need to do, when you want to calculate your adjusted present value, remember there are 4 procedures. The first procedure is to calculate base case NPV. The second one is to calculate PV of financing effect cash flow. The third procedure is to calculate adjusted present value. And the fourth one is to advise whether the project is financially viable. Those are the four procedures. Now we want to calculate base case NPV. I would then say calculating base case net present value. Our figures are in millions. Let's restrict our figures to million, or let's go back to the question. Did the examiner say we should do any restriction? So we are not told. So we are at liberty to either use million or thousands. In the question, examiner used million in some for some values. So we can decide to mirror that as well. Okay. So if that is the case, let's go ahead and solve this question straight. So I want to calculate base case NPV. It's a procedure. As we were reading, the useful life of this project is 4 years. So I will say year 0, year 1, year 2, year 3, year 4. Then I will create a column for working. In the question, examiner has told us that tax is paid in the year profit is earned. Therefore, there will be no extension. Okay? So I will go back to the question. Am I given selling price? Remember, when you want to calculate base case NPV, the same way you calculate your normal NPV is the same way you are going to calculate this. So let's go back to the question. Let's go and identify selling price. So the first bullet point, talk about the initial outlay. The second bullet point, talk about initial outlay. Then we're now told that the company will produce in the third bullet points. You are told that the company will produce and sell 1,300 units in the first year. Unit sale will grow by 40% in each of the next 2 years before falling to an annual growth rate of 5% for the final year. So let us calculate working for units. Unit is not given to us for all the years, so we need to grow that according to the instruction in the question. So let's go and calculate that. This one will be for the base case NPV. This will be for PV of financing effects. This will be for APV and the other ones. So let's bring our workings here. Workings. Working number 1, units. We want to determine the units. So we have year 1, year 2, year 3, year 4. So the units given to us in the first year, we are told is 1,300. So we're now told that this number of units will grow by 40% for the next 2 years before falling to a 5% growth rate. So in that case, since we have different growth rates, so I will just say 1,300, 1,300, 1,300. Then growth rate, inflation. We are told that 40%, 1.40. Remember, the first year units sold, you don't inflate the first year because inflation should start from year 2. Therefore, I will say raised to power 0. 1.40 raised to power 1. 1.40 raised to power 2. 1.40. Examiner now told us that in the final year, the number of units will now fall to 5%, meaning that the growth rate that you have in year 2, in year 3, which is 1.40 raised to power 2, is what that will fall to 5%. I would then say 1.40 raised to power 2 multiplied by 1.05. So it has 4 from 40% to 5%. So at this point, I need to determine, please bring out your calculator and help me to do all of this. So 1.4 raised to power 0 is equal to 1. 1 multiplied by 1,300 will give me 1,300. So what do you have for the rest? Debbie, where is everyone? Your line is breaking, Fidelis. Your line is breaking.
So can you hear me now?
Yeah, it's better.
Okay, 2,548 for year 3.
2,000. Year 3. 2,000.
Yes, I
5.
know.
No, your line is breaking. I can't hear you. Prosper,
Okay,
are you there?
2,548.
2,548. Okay. What about the rest? Yes.
One.
Your network is bad, Fidelis. Your line is breaking.
Yes.
1.40 raised to power 2 equal multiplied by 1.05 equal multiplied by 13 equal 2675. 2675. I'm done with that. Since you are not ready to provide, thank you, Fidelis. So the rest of you are not ready to provide numbers. I'll be doing it myself. Working number 2. I want to determine sales. In getting my sales, I need selling price. I will then go back to the question, what's the selling price? The next bullet point, we are told that unit selling price for the first year will be 3,750 naira, but this will increase by 3% per year thereafter. So examiner has given me 3,750 for the first year. Remember, when cash flow are stated in first year prices or year 1 prices, inflation should start from year 2. Therefore, let us go and inflate. So at 3%, so the first year price is 3,750. Therefore, I will then bring out my calculator, 3,750 multiplied by 1.03 equal 3863. 3863. What you have in your calculator, multiply by 1.03, multiply 1.03 equal 3978.
3978.
3978. Then for the final year, multiply by 1.03 equal 4098. 4098. So these are the inflated selling price. I need to multiply this with number of units to get total sales. This is my units, okay? Therefore, total sales will then be equal to, my figures are in million. So A multiplied by B. Therefore, I would then say 1,300 multiply by 3,750 equal
4875.
in million. So let's restrict our number to 1,000 then, so that it will be easier. So 4875.
Yeah, your phone is 532.
Year 3 is 5.
Year 4. Year 4.
Year 4 is what?
5327.
27. Okay.
Year 2, sir.
Yes.
7031.
7031. That means year 4 is not correct. Year 4 cannot be 5323 then. If year 2 is 7031,
Let's redo it.
please let's be fast.
Therefore,
Give
it's
it
11,
year 4
11,000 approximately.
11,000 watts.
It's 10,962.
Yeah.
Okay, leave it at 10,962. Okay then. Year 3.
Yeah. $10,136.
10,136. Is it correct?
Yes, it's correct.
So I'm done with sales. So I'll just go and post. But before then, let's do all our workings. So I will go back to the question. Am I given variable costs after number of after selling price? The next bullet point says that in the first year, total variable cost per unit will be 1,800 naira, but this will increase by 8% per year thereafter. So we also have variable cost of 1,800 with inflation rate of 8%. So let's go and compute that. Variable cost. So variable costs at inflation rate of 8%. The first year variable cost is 1,800. So 1,800 multiplied by 1.08. What do you get?
1944.
1944.
1944. 1944. Multiplied by 1.08.
2267. 2448. 449.
22. 22. Year 3 is 22.
Didn't get that. So.
Two. No, the third year is 2449.
2449.
Yes,
But
sir.
here I have 20. Let me do it again.
Okay, 2099. 203.
It's 20996.
Uh-huh.
209.
So 2099. Let me see. What do I have in the calculator?
So it should be 2100. Not
201. Yeah, that's the 2,000.
2100. Yes.
That's 2,000.
2100.
Yeah, 2,100. 2,100. So what you have in your calculator multiplied by 1.08. Yes.
2267.
2067.
2000.
267.
267.
267. All right then. So this is C. Then total variable cost in thousands will then be equal to A multiplied by C. So what do you get? A multiplied by C.
2340.
2340.
2538.
2538.
5351.
5351.
6064.
6064. So I'm done with variable costs. So let's go back to the question. Now, at this point, I can even post my whatever we have done so far. Let's go and post our sales. Please, you'll be calling the numbers for me so that I don't need to be flipping between pages. 4875 is the first one. Sales. 4875. What the second year says? Debbie.
7031.
31.
7031.
10136.
10136.
10962.
962. This is working number 2. Then we have variable costs. Variable cost for the first year,
2340.
2340.
2538.
2538.
5351.
5351.
6064.
6064. Working number 3. So the next item, let's go back to the question.
Sorry, sir. This year two variable costs.
Yep.
Not getting the same thing.
So what are you getting?
I got 3538. I
3538.
don't know if she.
Let me see. The first year is 1,800 multiplied by 1.08 equal, no, 18 multiply
1820, sir.
multiply by 1.08. I'm coming. That's 1944. Uh, yeah, 1944 multiplied by 13.
So it's not 1820. 1944 multiplied by 1820.
Let me go back to the workings.
It's supposed to be 3538.
Yeah, 3538.
35.
38, yes, sir.
So not 2538.
Yes, sir. It's 3, not.
Okay. It's correct now, right?
Yes, sir.
All right then. Thank you for that observation. So I would then call me 3538. Just correct. Change this one to 3. Okay. So let's move on. So after variable costs, the next item you are told that in the first year, fixed overhead cost will be 3,750 naira, of which 60% are centrally allocated overheads. The fixed overhead will increase by 5% per year after the first year. Now, you are given a centrally allocated overhead. That's head office charges. So it's an allocation. So 60% of the 3,750 naira is an allocation. Any apportionment is irrelevant cost. Therefore, you are going to account for only 40% of that 3.75 million. So if that is the case, let me go and do my working for that. Working number 4, fixed overhead. You are told that 60% is for the centrally allocated overhead. So what that means is that only the 40% is relevant. I would then say 40% multiplied by 3,750, since our figures are in thousands. So what do you get? What do you have? What's 40% of 3,750? Pardon?
1,500.
1,500. That's that. So figures are in thousands. You have to be very careful because you have restricted your number to thousands. So where you have a million, you should be able to convert it back to thousands so that you don't mix million with thousands. So I have fixed overhead. We are told that inflation rate of fixed overhead is how much? Is what percentage? Fixed overhead will increase by 5% per year. Okay. So there is no need for me to go and be inflating this. I will just come here 5%. The first year fixed overhead is 1,500. So 1,500 multiplied by 1.05. 1.05 multiplied by 1,500.
1,575.
1,575 multiplied by 1.05.
1,654.
Multiplied by 1.05.
1,736.
1,736. Thank you. Next item. Let's go back to the question. AL will require working capital of 15%, so we don't need working capital for now. All right. There is another figure in the second paragraph. In the third paragraph, we are told that a feasibility study commissioned by the directors at a cost of 5 million naira has produced the following information. That feasibility study of 5 million naira is irrelevant. Okay? It's a past cost. Therefore, you ignore because some cost is irrelevant. So in that case, let us determine the net cash flow, sorry, the profits. So give me the profits. Pick it one by one.
Yeah, 1,1035.
1,035.
Year
Year 4 is 3162.
Year 4,
3162.
3162. Okay.
Year 2, 1918.
1918.
3131.
3131. So this represents the profits attributable to the project. From these profits, we are going to pay tax. So let's go back to the question. What's the tax rates? What's the company tax rates? You are told that AL's tax rate is 25% per year on taxable profits. Tax is payable in the same year as when the profits are earned. Okay, so in that paragraph, we have tax rate of 25%. Quickly, so let us multiply at 25%. What's 25% of the profits for each year?
Year 3 is
Yep,
783.
783,
The one is 259.
259,
Year 4 is 791.
791. Year 2,
47.
480.
Oh, sorry.
480.
480.
4.
80.
480.
Okay then. Thank you guys. So let's move on to the next one. Immediately after your tax, you need to consider tax saved. Tax saved on capital allowance. Tax saved on capital allowance. Let's go back to the question. How are we going to claim capital allowance? In the same paragraph, we are told that tax allowable depreciation is available on the plant and machinery on a straight line basis. It is anticipated that the value attributable to the plant and machinery after 4 years is 600,000 naira of the price at which the project is sold. No tax allowable depreciation. When we were having capital budgeting, I mentioned that you can't claim capital allowance on second-hand assets. When you look at the first bullet points, you are told that the company can buy an existing suitable factory at a cost of 16.5 million naira payable now. That's your initial outlay, okay? But the company cannot claim capital allowance on that existing asset because the original owner might have been claiming the capital allowance. The second bullet point, you are told that 4.5 million naira is required now to buy and install the necessary plant and machinery. So that 4.5 million naira is a qualifying capital expenditure, but the 16.5 million naira is not a qualifying capital expenditure. All right. So if that is the case, we need to calculate capital allowance on the 4.5 million naira only. And that's what examiner is telling you in that bullet point, that tax allowable depreciation is available on the plant and machinery on a straight line basis, meaning that you don't claim capital allowance on the existing factory. So if that is the case, let's go and calculate our capital allowance. Working number 5, capital allowance. So since it's on a straight line basis, I don't need to waste my time. I will just say capital allowance, annual capital allowance equal to the cost of the assets minus the scrap value, okay, divided by the useful life. Divided by the useful life equal. The cost of this plant and machinery is 4,500,000 minus scrap value of 600,000. Because the examiner has told us that, let's go back to the question. You are told that it is anticipated that the value attributable to the plant and machinery after 4 years is 600,000 naira of the price at which this project is sold. No, this project is sold for 24 million naira to a group of young investors. You are now told that out of the 24 million naira, 600,000 naira is a disposal value for the plant and machinery. So if that is the case, since I'm calculating capital allowance on the plant and machinery alone, so I will pick the cost, which is 4,500 minus the disposal value of 600, then I will divide it by the useful life of 4 years. So what do you have as your annual capital allowance? 3,900 divided by 4. What do you get?
75.
975. 975,000 naira. So 975 is my capital allowance. Therefore, my tax saved on capital allowance is equal to annual capital allowance multiplied by company tax rates. So what do you get? So this will now be 975 multiplied by 25%. So this will give me what? What do you have?
244.
244. So when you it's 243.75 or something. So if you multiply 244 by 4 years, you are going to have 976. So because you can't claim more than the normal capital allowance. So you are supposed to claim 975. But if you multiply 244 by 4, it will give you 976. Therefore, the final capital tax saved on capital allowance will reduce it by 1. All right. So let's go and post 244 for each year. Then the final year 243 to make up 975. So it's a claim 244, 244, 244. Then the final year 243. That will make up the total capital allowance of 975 for number 5. Then after tax saved, we need to have sales proceed or scrap value. We are following a format. So we are told that the project will be disposed to a group of young investors for 24 million naira. So here is 24,000. Next item is initial outlay. Let's go and compose our initial outlay. Our initial outlay are in 2 folds. One is 16.5, then plus 4.5. That's 21 million. But let's do the working. Number 6. Initial outlay, which is equal to 16,500,000 plus 4,500 equal to 21,000. That's our initial outlay. Here is 21,000. Then we have working capital. So let's go back to the question. How do we calculate working capital? Yes, in the bullet point before the tax rates, you are told that AL will require working capital of 15% of the anticipated sales revenue for the year. At the beginning of each year, the working capital is expected to be released at the end of the 4th year when the project is sold. So working capital is 15% of sales. So let's go and calculate that. At least in this, for today, we should be able to complete the base case MPV. Maybe in our next class, we complete the question. Your time is already fast spent. Number 7, working capital. year 1, year 2, 3, 4, then total. So we are told that working capital percentage is on sales. Working capital is 15% on sales. Working capital at 15% on sales. So the sales for the first year, according to our working, is 4875. So what's 15% of 4875?
731.
731. Thank you. Here is 731. Sales for the second year is 7031. What's 15% of 7031?
1055.
1055. 1055. Then the third year, 15% of 10136.
1520.
1520. Then the fourth year, 15% of 10962.
1644.
1644. So you can see that the working capital is increasing for the respective from 731, it has increased to 1644. So let us find the incremental working capital. Remember, based on our explanation on the relevant cash flow, we said that when there's incremental working capital, only the increment should be considered, and it should be treated as cash outflow in the year before the year of occurrence and recover fully at the end of the useful life. Therefore, I would then say incremental working capital. The first one is 731. So 731 minus 1055, what do you have?
324.
324. 1055 minus 52, 1520.
465.
465. 1520 minus 1644.
124.
Pardon?
124.
124. So when you add up everything, you should have 1644. Okay, we should have 1644. Therefore, what's the relevant year? Remember, the rule says that working capital should be treated as cash outflow in the year before the year of occurrence and recover fully at the end of the useful life. The first year working capital should be treated as cash outflow in year 0. The second one, cash outflow in year 1. The third year, cash outflow in year 2. The fourth year, cash outflow in year 3. Then at the end of the useful life, which is year 4, you recover all the working capital. That's that. So let's go and post. 731. Here is 731. How much was the next one? Yes,
324.
324. The next one,
465.
465
124.
124. Thank you, Debbie. So that's that. At this point, I need to get the net cash flow.
Sorry, I have a question, sir.
Yes.
Now, in our previous class, you said something about when the incremental value, right, decreases, that will be treating it as an inflow, right?
Yes, that means that's been recovered.
Yes, sir. So the year three there is a reduction, there is a decrease
There is
in
no decrease there. We don't have everything is increasing from 731 to 1644. There is no decrease. You can see your incremental working capital has increased. So see your working capital. You have 731, you have 1055, you have 1520, you have 1644. Is there any reduction? Your working capital is increasing, not decreasing. We are not talking about the increments. It is increment that is reduced to 124. That's not the increment. Your main working capital is increasing from 731 to 1055 to 1520 to 1644. Do you get?
yes, sir. Thank you, sir.
Yeah. So when you are considering the increment can be either up and down, but that's not the major. The major one is on your main working capital. That's where you check whether it has reduced or is still increasing. So if your working capital is increasing and at a point it starts falling, it means that the company has recovered part of the working capital. Okay? So move on.
All right. Thank you.
Okay. So this represents our net. Find me the net cash flow, please.
696.
696.
1217.
1217.
2468.
2468.
Two eight five eight.
2858. Thank you.
Oh, 28258, rather.
28.
258.
28258. Okay. Okay. Yeah. No problem. Now, so after the net cash flow, the next thing I need to do now is to now discount the net cash flow using cost of equity ungeared. So with this net cash flow, I need to discount it using cost of equity ungeared. I will then go back to the question. I will go and check where I'm given information of a proxy company. All right. If you go to the question, second to the last bullet points, you are told in the question that although no other companies produce yam pounders in the country, Cantona PLC produces cassava crushing machines using almost similar technology to that required for yam pounder. CS cost of equity is estimated to be 14%, and it pays tax at 28%. CS has 15 million shares in Niger, trading at 2 naira 53 kobo each, and 40 million naira bonds, trading at 94 naira 88 kobo per 100 naira. So you can see, examiner has told me that there is a cost of equity for Cantona Limited to be 14%. So examiner give me cost of equity of 14% for proxy company. That means I'm supposed to use Miller and Modigliani formula to calculate my cost of equity ungeared. So let's go and calculate cost of equity long gain. Working number 8. Cost of equity ungeared KEU. How do I calculate my cost of equity ungeared? I told you there are 3 ways. If you are given beta value of a proxy, then you identify the proxy beta, you ungear the beta, then you calculate cost of equity using capping. If you are given cost of equity of a proxy, simply calculate cost of equity ungear using Miller and Modigliani formula. If you are given work of a proxy, then you calculate work of ungeared. So all those 3 formulas I gave to you earlier today. Therefore, I would then, since I'm given cost of equity of a proxy, then I would then say cost of equity of a gear equal to cost of equity on gear plus, open a bracket, cost of equity on gear minus cost of debt multiplied by debt value into 1 minus tax divided by equity value. Okay, then. So if that is the case, I would then say my cost of equity of a gear is 14%. So I will say 14 equal to what we are looking for is the cost of equity on gear. So cost of equity on gear minus cost of debt. Let's go back to the question. What's the cost of borrowing? We are told that there is a debt of 40 million bonds, 40 million naira bonds. So that 40 million naira bonds is the debt. So I need cost of that 40 million naira bond. So you can see in that particular paragraph, examiner did not give to us the interest rates associated with the bond of 40 million naira. So if you are not given the cost of debt, so it means that you are supposed to assume the risk-free rate of return as your cost of borrowing. So as your cost of debt. So if that is the case, I would then, in the last paragraph, you are now told that the 5-year government debt yield is currently estimated at 4.5% and the market risk premium is 4%. So examiner has given you 5-year government debt yield to be estimated as 4.5%. That 4.5% is your risk-free rate of return because it's the rate of return associated with government security. Okay? So if that is the case, I will then go back there and slot in. So we are going to assume the risk-free rate of return as cost of borrowing. So multiply by, minus 4.5. Oh, sorry, I didn't leave a space. So 14 equal to KEU plus KEU minus 4.5. Let me cancel this. Then multiply by debt value. Let us go and determine debt value. So for Cantona, how do we determine market value of the bond? We want to calculate market value of the bond. Examiner has told you that the bond is trading at 94 naira 88 kobo per 100 naira. So value of the bond. Working number 9. Let me come down here. Market value. Market value of the bond. Debt equal to nominal value multiplied by X int price divided by 100 naira. Therefore, nominal value is 40 million. Since our figures are in thousands, so I will say 40,000 multiplied by the market value per the unit of the bond. We are told it's 94 naira. So 94 naira 88 kobo per 100 naira. So what do you have here? 0.9488 multiplied by 40,000. What do you get? Yes. Are you still there?
So 37,952.
37,952. Thank you. So let's determine the market value of the equity for Cantona. Equity value equal to number of shares. Am I given number of shares in the question? Let me see. Yes, we are given 15 million shares. So I will say number of shares multiplied by XDIV share price. And the XDIV share price is 2 naira 53 kobo. So number of shares multiplied by XDIV share price will equal 15 million share. I will say 15,000 since our numbers are in thousands. 15,000 shares multiplied by 2 naira 53 kobo. So what do you get?
37950.
Thank you. So I've calculated market value of debts and also equity. So let us go and slot in there. 37952. Debt is 37952 into tax rate of Cantona is 28%. So we account for 72%. Divided by 37950. So what do we have? 14 equal to KEU plus KEU minus 4.5 multiplied by, what do you have here? 37952 multiplied by 0.72 divided by 37,950. What do you have? Yes. What do you have? Multiplied by 0.72 equal divided by 37
0.72.
950 0.72 0.72. So we need to expand. So I would then say 14 equal to KEU plus 0.72 KEU minus 0.72 multiplied by 4.5 multiplied by
3.2.
3.24. 3.24. So at this point, I need to collect like terms. So collect like terms. I would then say, before then, I will say 14 equal to KEU is 1 plus 0.72 KEU. That will give us 1.72 KEU minus 3.24. So I will collect like times. So 1.72 KEU will then be equal to 14 minus, so that will be 14 plus 3.24. Therefore, KEU will then be equal to 17.24 divided by 1.72. This should give approximately 10%. Please confirm. Is it?
Yes, sir.
All right then. So if that is the case, I will then go and discount my cash flow since I have cost of equity on gear of 10%. 10%. So for year one, year zero is 1. So here will be 0 0.909, 0 0.826, 0 0.751, 0 0.683. Here is working number 8. Then I will get my present value. Give me the PV. Here is 21,731. Okay. What's the PV for the respective years?
633. Year one.
Year one is 633.
633.
Year two is 1005.
1005.
Sorry, year one is in
Ye-
thousand.
Year one is 696 multiplied by 0.909.
Let me do it.
Year three is 1853.
1853.
3.
Yeah, it's correct, sir.
Okay. Therefore,
19,300.
19,300.
300.
So 19,300 plus 1853 plus 1005 plus 633 minus 21,731. Final answer. What do you have as your base case NPV?
1060.
1060. Thank you. 1060 is the base case NPV. Okay. Uh, so you have a ruler, so I can't be ruling this. It's too long for me. All right then. So this is where we are going to end the class for today. By the grace of God, we continue in our next class when we shall be treating the other parts of the question, which is the present value of financing effect cash flow. So let me hear from you. Do you have any question for me or any concern on our calculation so far in this question? Is there anything that is not clear? Some of you have disappeared. No worries. It's noted.
Sir, can you please scroll down to the working number 9?
Working number 9. That's our last working. Okay, market value. What about it?
It's okay, sir. I didn't capture it. Thank you, sir.
Okay. Okay,
Question.
talk to me.
Yeah, this during the calculation of our sales, right?
Yeah.
I did not really understand what we did on the selling price. We did 3% of what?
No. Your first year selling price is 3,750. So you just grow. You don't grow. You don't grow the first year price. So because you are given the first year price, inflation should start from year two. Therefore, 3,750 multiplied by 1.03 we give you the second year, which is 3,863. Whatever you
Okay.
have, then you increase it again by 1.03, you get 3,978 on and on like that.
All right. Thank you, sir.
You're welcome. Any additional question? Okay. So in the absence of no further question, I will stop sharing these documents. Then we close the class for the day. Thank you guys for your